So, what's the deal with the global economy in 2026? We've gone through forecasts from some of the world's top analysts to give you a clear, no-nonsense picture of what's on the horizon. Let's get right into it. Okay, so the big question on everyone's mind is pretty straightforward, right? Are we gearing up for some real growth, or are there some hidden traps that could bring everything to a grinding halt? The truth, as it usually is a bit more complicated. It's this really delicate balancing act between the two. The theme that keeps popping up for 2026 is this phrase, subdued resilience. It's a weird paradox, really. It means the economy is actually showing some surprising strength, but at the same time, it's kind of walking a tightrope. It's super sensitive to every little policy change and every bit of global tension. That push and pull is really the heart of our forecast. All right, here's the game plan for today. First, we're going to look at the baseline forecast. Then we'll get into the absolutely massive impact of AI. After that, we'll explore why different economies are drifting apart, how the big central banks are handling it all, and, this is the important part, what it all means for you. And we'll wrap up with the major risks you'll want to keep an eye on. Okay, let's dive right into section one, a resilient but tense economy. So, what are the big headline numbers telling us? The number you'll see everywhere is 3.1%. That's the consensus for global growth. And on the surface, that looks pretty stable, pretty steady, but that number doesn't tell the whole story. See, this growth is really policy dependent. That means it's basically being held up by decisions from governments and central banks, not just pure organic economic power. In other words, it looks solid, but it's more fragile than you'd think. But, and this is a big but, there's a massive force pushing back against all that fragility. There is one single thing propping up a huge chunk of the global economy right now, and that's artificial intelligence. In fact, for the United States, it is now the single most important engine of growth. As Chris Heisey over at Merrill puts it, power is driving the global economy. And this quote, it just nails it. This isn't just another tech fad. AI has become a fundamental economic force, and it's rewriting the rules for everything from our power grids to how money moves around the planet. And that force is fueling an unbelievable spending spree. We are literally in the middle of one of the biggest capital expenditure cycles, that's just companies spending on big long-term stuff, in decades. It's even bigger than the telecom boom back in the 90s. And all this money pouring into data centers, chips, and power grids is spilling over into the whole economy, creating everything from construction jobs to new defense tech. And look, the numbers here are pretty staggering. Barclays estimates that all that AI spending was responsible for a full 1% of US GDP growth last year. And when you look at individual companies, the ones that got in early are seeing incredible productivity boosts. We're talking an average of around 30%. This isn't just hype. It's real, measurable economic impact. Okay, but here's the catch, and it's a big one. This AI boom isn't happening everywhere. Which brings us to our next section, the Great Economic Divergence. The world's biggest economies are starting to split off and follow very, very different paths. And you can see this split clear as day when you put the US and the Eurozone side by side. The US economy is just supercharged by AI and strong consumer spending, but it's also stuck fighting this stubborn inflation. Over in the Eurozone, things are moving at a much slower, more cautious pace. Growth is lower, but their inflation is actually getting back under control. This whole divergence thing is happening in emerging markets, too. It's a really mixed bag out there. But in this mixed bag, one country is just crushing it, and that's India. Thanks to booming domestic demand and cooling inflation, it's on track to keep its title as the world's fastest-growing major economy. It's a huge contrast to what's happening elsewhere. So it makes total sense, right? If economies are heading in different directions, the people steering them, the central banks, are going to take different routes too. So let's jump to our next section and look at how these policymakers are dealing with this new reality. You don't need to look any further than the interest rate projections to see what's happening. In the US, inflation is just being super sticky, so the Federal Reserve is probably going to have to keep rates up over 3%. But in Europe, where the economy is slower, the ECB has way more room to cut rates, maybe all the way down towards 1.5%, to try and get things moving again. So what's the big takeaway from all this for anyone watching the markets? Well, ING Research has this great football metaphor. For the last couple of years, everyone's been playing the man, hanging on every single word from the central bankers. But now, in 2026, the game is changing. It's time to play the ball, to focus on the fundamentals, things like actual growth, debt levels, and how much money companies are making. All right, let's bring this all down to earth. This is the part that really matters. What does all this global stuff mean for you, for your wallet, your home, your investments? So, what does this actually look like in real life? Well, take the US housing market. There's some good news on the horizon. The National Association of Realtors is actually forecasting a nearly 14% jump in home sales for 2026. Why? Because of steady job growth and the real possibility of lower mortgage rates. We're seeing the same kind of split in the world of commodities, too. For old energy, like oil, the outlook is getting weaker because it looks like demand is about to peak. But for the materials that are fueling the new energy economy, we're talking metals like copper, demand is just exploding. This whole green transition is kicking off what some analysts are calling a new supercycle, which means a long period of high prices for these really critical metals. So, what's the bottom line here? It's pretty simple, actually. We're living in a world defined by divergence, where economies are splitting, policies are splitting, even commodities are splitting. In that kind of world, diversification isn't just good advice anymore, it's absolutely essential. Spreading your investments out across different industries, different countries, and different types of assets is the number one strategy for getting through the year ahead. Okay, but no forecast is ever a sure thing, right? We have to talk about the things that could throw a wrench in the works. So for our final section, let's look at the key risks that could change this entire picture. Analysts are basically keeping their eyes on three big potential problems. First, all the ongoing trade friction and tariffs are still a major drag on global trade. Second, there's a lot of political uncertainty building up around the 2026 US midterm elections, and that can make markets really jumpy. And finally, the elephant in the room. Are the crazy high prices of AI stocks for real, or are we just sitting in a massive bubble waiting to pop? So there you have it. That's the lay of the land for 2026, an economy defined by this subdued resilience with incredible new engines of growth right alongside these deep, widening gaps. And so the question we want to leave you with is this. In a world with so much divergence and disruption, how do you build a strategy that's tough enough to handle the risks, but also nimble enough to grab the opportunities?